Hello, Greg. I don't see you on the camera. Hello, I hear something clicking around.
Can you hear me, Mike?
Now I can. Hey, Greg. Oh, I could hear you. There he is.
Wouldn't let me unmute video or audio, so I logged out and logged back in.
No worries. So I definitely want to cover what Allison sent over.
Yeah, I've got a slide what she referenced.
Oh, okay.
I figured we would go over that and then we can move on into everything else. Let me share my screen.
All right. So how are things going?
Good. Just watching crude get annihilated again today. So whatever goodwill, literally just gets annihilated in an hour and a half's worth of trading. So it just, there's going to be pressure on commodities, and can lumber continue to separate itself out? I was surprised with the commodity fund short liquidation last week. I think that was a gift as far as seeing Sep trade up to 750.
Yeah, yeah, right. Anyway, why don't we kick this thing off? We're a couple minutes after noon. We got some folks there. I'll pull up LinkedIn just to see where people are at there. There's that. Let's see what I got here. Go live. Oh, yeah, we got 14 people there. All right, let's go. Let's do it.
Good deal. Hello, everybody. Hello, Mike.
Hello. So, yes, let's start this off.
Let me get this into slideshow here. Hang on 1 second. Let's go this way.
Yeah, and I'm going to try to make it a little bigger here.
There we go.
Oh, no, that covers some of it up. I guess we'll go back to here. So we made some statements that were not entirely correct last week. And thankfully, our good friend Allison from the CME group called us or sent us an email to help clarify. And we really appreciate that. So let's start out with number one. The existing lumber futures contract daily price limit structure will not change. And actually, you know what's interesting, Greg? Allison made a comment to me that when you do the percentage of the price, because they're at two different delivery points,
right,
the limits would never be the same anyway, because the prices were going to be different.
Right. No, and I think that's a great point that, just so everybody is aware, the existing legacy contract is still going to be FOB Prince George. The new contract's going to be FOB Chicago. So you're going to have the market figure out pretty quickly what that adder is to get you freight to Chicago. Is it $85? Is it $92? Is it $98? So you will have, when you look at the board and you have these contracts side by side, you're not going to be doing an apples to apples comparison. One's going to reflect FOB Prince George, the other one's going to reflect Chicago.
Yes, yeah, absolutely. So there's, I guess we'll see what the real freight is pretty quickly there, right?
Yeah. So that goes into the old contract. The existing contract still going to have that semi-annual reset. That 45-day window leading up to May 1st, leading up to November 1st. The new contract's going to have the circuit breaker format. So you're going to have some, above and beyond that freight, you're going to have discrepancies in the daily limits in any given day, which will be, that's a lot of fun to figure that out. Where you might have the existing contract lock limit, and then you have the ability to conceivably do something about it because the new contract's trading, which is pretty cool.
I mean, I got a sense that everything's going to migrate pretty quickly.
Yeah, I think that's my hope. That's the CME's hope. So this all, like number two, this is coming up very soon. As soon as we have the details on this, the CME is going to host a 5-part webinar series that's going to cover everything and anything under the sun in regards to migration, the new contract, and you'll be able to ask the CME direct questions. You'll have Laura Mishke, Laura Bushney, who's head of deliveries at the CME. You're going to have all the right people engaged at the CME that actually wrote this contract line by line that will be able to answer very specific industry related questions. So as soon as that information's out there, we'll blast it out there. And then the last thing that Allison wanted us to, even if 100% of these contracts migrated to the new contract, you would need a special circumstance where they'd have to get CFTC approval to delist the existing legacy contract. So it can happen. It's probably unlikely to happen. So the reality is the existing contract trades through May of 2023, and you're going to have side-by-side markets with the hope that everything from the existing migrates to the new contract.
And yeah, realistically, the open interest drops to zero. Trading will halt in a contract, not because the CME says it. It just, there will be no participation.
Yeah, and the other neat thing, Mike, this past week, and he's reached out to all the brokers. There's a market maker within the CME that the CME's contacted, in a very similar capacity to what you used to do, where he trades multiple markets from butter to milk to some of the larger markets like soybean oil. He does a lot of delta neutral trading. His firm does, to where they go in and legitimately make markets, add liquidity to markets in options and futures. So that's exciting that the CME's already begun that process, to where, instead of hoping, they're going to do everything in their power to kind of give liquidity to this market from the get-go.
Perfect. Yep. Sounds great.
Let's jump. This is all just old stuff from last week. So the big thing, over the last 5 days, lumber's back in the winners column here, where we're up. And again, this doesn't reflect, I think this is as of yesterday's close, but lumber is up 4% over the last, this would have been through yesterday's close. The big one here is natural gas. And then this is the other one that I wanted to point out, the US dollar index. And, this goes into the next chart, and this just kind of gives an overall perspective on commodities. And crude oil today is getting annihilated, where WTI crude is well under $100. We're at $96. We're within $1 of retesting the recent low. Brent crude is back in that dollar area now. So, my big takeaway when you look at all these markets, again, here's lumber, but lumber is a basket, it's another commodity in a basket of goods. And the big takeaway is you've definitely had a topping out in commodities. Here's copper, gold, the grain markets, crude oil, and a lot of this is a direct result of a strengthening U.S. dollar. And this is, probably by design, that you, in order to control inflation here, you strengthen your dollar. A strong dollar makes your commodities weaker, not stronger. And so you try to rein in inflation, with your interest rate structure, and then also your dollar structure.
So I got a little commentary on this as well, and I'm starting to just tease out what I think on this. But there's a big issue in Europe right now with power, and much of Europe's power comes from natty gas.
You read my mind, Mike.
Okay.
Yeah. This is just amazing. So you can see the complete detachment of U.S. natural gas versus Europe natural gas here, and just look at euros a megawatt hour. Look at the cost in U.S. natural gas, which is down here, versus what it costs in their version of natural gas, their European natural gas, obviously, which is a significant byproduct of Russia. It's pretty staggering. I mean, this chart just jumps out.
Well, and this is reflected in the strong dollar. Europe is heading towards a major recession. Right now, they are trying to limit their electricity use so they can fill their natural gas storage for the winter months. I mean, they have a potential catastrophe on their hands if they don't have enough natural gas to actually run the heat plus electricity in the winter. And this is, in my opinion, part of Russia's play to force their political agenda.
Absolutely. Yeah, no, and that's, just so geographically here, obviously there are huge swaths of this, North America, the U.S. that don't necessarily have to heat or have very minimal heating related costs. And then geographically, you get into heating oil in the Northeast, where you've got natural gas, you've got heating oil. There are multiple ways. In Europe, I want to say something like 85% of Western and Eastern Europe are heated with natural gas.
Electricity made from natural gas.
Yeah, exactly. That, yeah, yep.
Now, why does this matter? I think it's really important. If Europe gets thrown into a massive recession, they're not going to be building a lot of homes. The lumber producers over there are still going to want to produce, right? Run. They're going to be shipping wood to the U.S. So now you've got the combination of a strong U.S. dollar and a weak European takeaway. We could see the Eastern Seaboard get flooded with wood, and the initial reaction to the whole Soviet Union thing in Ukraine was that, we're not going to get any fiber out of the Russia. That's going to reduce the number of European imports coming to the States. And what I'm kind of teasing out right now, it's interesting. It could be the exact opposite. We could see a flood of European wood hit the United States.
Yeah, no, I think it's it's very fluid, and what we think is obvious today doesn't necessarily become that obvious, especially if they do go into a hard recession, or if Russia just cuts them off 100% and plays hardball. And the other part of this is, the reason energies are down today is Asia, China is re-implementing COVID type strategies again, where, you've got complete fear of lack of demand globally now, kind of weighing heavily on whatever supply constraint issues exist with crude oil and energies, heating oil, RBOB, unleaded gas. The market, and I'm going to jump around today, but let me find this. This is a funny chart. Not funny in the sense that we're back to this is the R word. It's getting harder and harder to avoid hearing about recession risks, and this is the number of times recession is used on all sources on the Bloomberg terminal. So you're back to the onset of the pandemic, and we're going to go into a depression as far as the use of the word recession right now.
I saw a similar analysis of the word perfect storm and how many times it's being used to describe situations. But
all right, so we'll quickly run through all this other stuff.
I want to highlight one thing: copper, lumber, and copper are two commodities that are fairly lightly traded from a financial standpoint, but are absolute telltales as far as future economic.
Yeah, and you always hear the copper's got its PhD in trading, and I think lumber is a pretty
professor.
close second, if not, if not even a better leading indicator than copper. Where let me see if I have. And again, I apologize, I'm going to jump all over, but there's lots of. Let me pull up this one chart here. I didn't add this to the slide deck, but I think it's relevant from a copper standpoint. Let me just pull this up here.
And you know what? While you're doing that, in the news this week, we were talking about the number of percentage of new home contracts that were canceled.
Yep.
It looked like a big number when I first glanced at it, and then I realized that, well, there's cancellations all the time. It's elevated. I think it was around 13.5% when the normal rate is just under 10%. So it's not surprising that we are seeing new home contracts getting canceled. But it's something relevant to take a look at.
Yeah, and so we'll just wanted to show this. This is year to date. This is the S&P down years, 1976 through current, and you can see how this ranks relative to previous down years. And then you can kind of see what's interesting, how everything else, if you had this is the ag index, and then this is a bond index basically, and then this is if you had a mixed portfolio where you would be. So if you had a 60-40% allocation of 60% equities to 40% bonds, year to date, you'd still be down 16% versus 20%. So you're not seeing the traditional asset classes that would give some kind of reprieve when equities are taking it on the chin. Long story short, what this is telling you, and there's other charts that I didn't include, but there's really nowhere to hide unless you're in cash. There's no saving grace out there as far as the obvious things where you would get benefit when equities are in a downtrending market aren't necessarily working like they historically would right now. Jump into housing here. This is Goldman Sachs put this out. This was kind of in the headlines in the last week, but Q1, U.S. households withdrew $82 billion of home equity in Q1, the largest amount in 15 years. So there was a lot of cash taken out of houses. And so here's another way of looking at this. Obviously with the low interest rate environment, you had a lot of money withdrawn, which goes into people's pockets one way or the other. So, that's the one benefit of, so even though mortgage, so you have, the blue line is housing asset valuation, and then the red line is mortgage debt. Even though you have increasing mortgage debt, basically higher now than 2007, 2008, 2009, you can see from a valuation standpoint, houses are well valued. And, again, going back to this, you've had a massive pullout of equity out of people's homes and into their pockets, which, again, hopefully gives people a buffer as far as we've talked about personal consumption and then personal savings, where, again, if you've been the beneficiary of home ownership, you've gotten to take full advantage of this appreciation in housing, in the form of pulling money out of your house.
All right. So
This was another good one. Year-over-year change in entry-level mortgage payments. You could just see some of the, like kind of New York, San Francisco, the more obvious ones. But something tells me in Raleigh, Durham, wage growth isn't anywhere near 57% year over year.
Well, I just look at that median, 39%.
Yep.
So if your mortgage was 1,000, your entry level mortgage was 1,000. Now it's 1,400.
Yeah.
It's a big deal. 400 in a month. That's a big deal.
And so, this is another great one that just shows interest rate volatility, mortgage rate volatility, and you can see just kind of look at this change from the middle of June to the first week in July. I mean, you don't do this to have these kind of wild swings in both directions is historically pretty unusual. You can kind of see, figure out your mean here, and you're getting pretty big standard deviation moves away from your mean type average on interest rates now. So, again, that's the hope that maybe interest rates peel back under 5% or low fives, and there's this resurgence of people on the outside looking in from a demand standpoint. This is the other one. Goldman Sachs has this housing affordability index, and you want this going the other way. So you can see you're back to, as far as not being able to afford a home here, you're back into that 2005, 2007 kind of window right now. So jobs, I thought this was interesting. Job openings versus the unemployed seeking work. You're starting to see a narrowing here, and you see it better with this chart where you're finally back to, or getting close to, back pre-COVID. So there's always been a big disconnect, or a bigger disconnect, between jobs and people looking for jobs. But you can see how you're definitely have narrowed the gap now, and you're getting closer and closer to pre-COVID type levels. And you can kind of see it on this chart as well now, where here's your kind of, if you were to average this out, you're kind of getting back closer to this average type growth.
Okay.
We did that. So let's jump into lumber. Make sure I didn't miss another. Let me do one more chart here. I ended up having to buy a car. I've got a 15-and-a-half-year-old and a 17-year-old, and this just, like, again, the idea of inflation, new cars versus used cars. It's pretty amazing. Who can afford to buy a car?
What kills me is the used car right now payment is the same as the new car payment was 3 years ago.
Yeah, no, I drive a Toyota 4Runner, and legitimately, my payment is today, I don't know if I could afford it if I had to buy it again today.
No, for sure.
Let's jump into lumber. So EFPs, we're about 133 EFPs for the July contract. Coming into this morning, there were 110 Julys left. I can tell you, between Alex and myself, with EFPs that still have to be processed off the books, my guess is net Julys are somewhere around, somewhere in the 20 to 40 area. Everything else will be EFP'd off. So July this morning at 119 contracts, there's still a big chunk of that still has to be added into this EFP.
Okay, so it's going to come out to probably pretty high.
Pretty close.
Nothing in the tea leaves there.
So jump into the lumber charts here. Weekly continuation. The market's had a nice rally off of the lows. You're back to the 9-week now. And, the market, you could make the case that, maybe there's a run in the cards here to 800, or maybe there's a retest of the lows, or you just go sideways. But the market seems to be at a big inflection point here as far as what it wants to do next. Here's the July daily. There's nothing that really jumps out here. July right now is 643, down 1810. That July-September spread is -40 last. So it's kind of interesting with this uptrending market as of late. That Sep Nova Spread is trading at a premium. That's 14 over. But the expiring contract here, you could still realistically buy this 30 to 50 under. So just even with just a net July value, there aren't people lining up. There doesn't seem to be a shortage of prompt wood out there right now, or the anticipation of a shortage of wood, given just looking at the July and that July Sep spread. Here's September. September, obviously. This was last Monday. I'm sorry, this is last Monday. September spiked down to the 620 area. Last Friday, we spiked up to the 750 area. And then on Monday of this week, we actually almost traded limit down within 10 cents, 658.10. So you've had a lot of volatility in September off of very light volume to kind of vacillate in this 650 to 750 area.
I'm going to share my screen real quick. I just want to show something on a chart. So this is off bar chart. This is the September. Well, it's the nearby daily. So, it changes whatever. When it was back here, it was May, and then it turns into July. But on this chart, I put up a Fibonacci retracement. Mm-hmm. And my experience with lumber is lumber likes to go halfway back. It tends to go back to a 50%. When I first took a look at this, I said, okay, I see no reason why lumber can't rally off the lows 50% back, which takes you, right here, just under $1,000, $950. So as we bounced off these lows, my target actually was, I didn't think we could get to 1,000. That seemed to be, sometimes you get those psychological levels. So I said, hey, what if it's 50%? Well, if you don't make it back to 50%, that can tell you that things are a bit weaker than you had anticipated. So kind of like you said, Greg, we seem to have petered out a little bit on this bounce. If we roll over with any significance here, I think the market's weaker than we anticipate.
Yeah, and then part of this. So this is the September. Just seasonality. Skip over that. We still have high implied volatility, but I want to jump into. Here's that July-September spread. So again, that spread went from 25 under to basically the 50 over area. We collapsed earlier this week. It did trade. There was some volume done in that -60 to -65 area, and they're trying to stabilize. But then when you look at this Sep Nova spread, and part of this, the commodity funds we all know rolled their July shorts into September. And then we'll get into open interest. We're losing open interest. You'll see it in the CFTC numbers. But, part of this move from going from, 25 under back to even money, and then even money back to 10 over, and then it did trade as wide as 29.40. Part of this move here and the Sep Nova getting blown out is definitely a reflection. We'll come back to the basis here, Mike. But I just want the CFTC numbers, managed money, surprisingly, given all the headwinds out there, you technically were able to trigger out some of these commodity fund shorts that literally just rolled their position from July into September. And for whatever reason, they definitely helped fuel that move. Sorry, making everybody nauseous here. They definitely, go back to September, they definitely helped fuel this move. From, again, starting off the week, and I'm sure you had some weak-handed momentum guys sell the 620 in September and then just get completely caught in this move up to 750, where you definitely took out some of these weak-handed commodity fund shorts. That definitely helped, along with cash stability. But the reality is you had commodity fund shorts that helped push this thing up to 750 last week.
Yeah, and if you go back to the the Sep Nova, I'm sorry, July Sep Spread. There's two things I want to point out. If you're trading this thing, you got to be careful for the volatility as you approach the end of the lead contract, the end of July. I mean, this is some massive moves in this spread.
Yeah.
And it's a fundamental change in thought, meaning, here at the beginning of this, where it last peaked out, I have my mouse over top it. I know you can't see that. But the belief was that the July contract had more strength, that people wanted wood right now, that they were, short their current cash position. Well, it dove. The reality was the business was pretty much covered at hand, and they were covering business into the future, this third quarter, late fall or early to late fall needs.
Yeah, no, and I think the other thing, Mike, I know we talk about the spreads, and you might not want to trade the spreads, but I think it's critical to help understand that spread relationship, that forward curve of futures, but also the spread relationship. And this should at least throw caution in the wind that we have an expiring contract this week in July, and it's at a big discount to where, I'm always skeptical. You still have July expiration ahead of us here this week, and somehow September is this leading indicator of what life is going to be like in September. I'm always skeptical when lumber tries to think that far ahead. That's usually a recipe for getting in trouble, where I'm more inclined to think, what's cash doing, what's front month doing. And I know September is technically the front month, but July's still on the board. If you need the wood, you can still conceivably buy July. Fraser 654 out of Alberta. You can still buy, even if you take that $7 deductor out of cash into futures, you can still buy at a discount to realistically where most mills are right now in futures and just take the wood. But obviously, all the EFPs out there right now are, all that stuff's already on the books. I don't have a lot of people giving me orders to buy July on some big pullback here. So it's tough to get overly excited about the September contract, and you see it in the Sep Nova. Too many things have to go right to kind of look at September as some kind of leading indicator of what lies ahead. I think you want to stay grounded in, when you look at the forward curve here, where's physical cash, where's the actual month going off, and do you deserve to be at these premiums? And okay, maybe you do, but be very careful in thinking when you look along this curve. And we saw this to the downside, that this is a leading indicator of what pricing is going to be for this time frame. I think you want to be careful there. And just when you look at this, all this tells you that there's a cost to carry of ownership the further you go. And it doesn't necessarily mean that prices have to be at these levels come November, come Jan, come March. This just reflects, at the end of the day, this reflects the bear market structure. This is a cost of carry structure where nobody really wants the prompt wood, so to speak. Very few people are concerned about finding immediate needs right now. Where it's one of those things where I don't want to, when we talk about the spread structure and the curve structure, it's important to understand what kind of structure you're in. And right now, as much as the market doesn't like it, we're in this bear market structure.
Yeah, I mean, theoretically, you go back to that chart, you could put a Nova March spread on, and when it comes time to expire the Nova, EFP it for something, and you've got $70 of basis already built in.
Yeah, absolutely. And I think that basis component of this, here's a rolling weekly average of basis. Again, you still have even with July on the board, and again, this was as of yesterday's close, but you still have a negative basis here. And then when you look at, okay, here's September, cash is trading, and again, this is as of yesterday's close, but do you deserve to have this basis? And what this tells me anyway is be very careful in looking at the strength along the curve in Sep and Nov as to what has to happen. That's your cost of carry. And at the end of the day, like you said, if this market doesn't, again, we talked about this inflection point. If you don't have that breakout to the upside, well, with these premiums and futures relative to cash, you could just as easily see that collapsing structure and give back this basis in the
Now,
back months relative to cash.
there is a reality to this. You buy wood in July, trying to store it for 4 to 6 months, you've got problems.
Yeah, no,
So,
and that's kind of why these back months have been bid up, because you can at least lay off the risk.
Absolutely.
So, open interest, this is as of Friday, July 1st. Total open interest 2265. Fast forward to yesterday, you're just over 2,000. There's not that, you can't account for everything in July. Again, go back and look at September 1640. Look at November 304. Okay, November's built out, but that September contract, again, the commodity funds that rolled from July into September, you see it in the CFTC numbers. The weak-handed shorts have gotten pushed out here on this move to 750. Once that buying subsided, you kind of settled back down to reality here, where again, September, we raced up to just south of 750 on Friday. And then yesterday, basically on the open, it took 60 cars to go back down to 658.10. So there's lots of volatility in the market right now.
Yep.
And then I just wanted to, Madison's put this out. People are always asking, what are the shutdowns? And I thought this was pretty good recap of what shutdowns are going on right now and to what extent, at least the ones that are public.
Well, and here's something I'd like to show. I'm going to share my screen, get yours off of there. So this is from Timber Online. And what you have is a chart of the softwood lumber imports into the U.S. So this doesn't account for any domestic lumber. In the first 5 months of the year, lumber imports are down 7%. The majority of that is made up of Canada being down almost 10%. Obviously, we get most of the wood from Canada. But we have a falling market in the first 5 months of the year and a falling volume imported. Those two don't add up to a strength, a strong market.
Yeah, great point, Mike. Yeah.
So if somehow like we talked about before, the European wood starts flowing here, it's going to put more pressure on it. Now we know that we're not going to get as much wood from Canada. Like that's a known. The unknowns here is how much wood's going to come from offshore. And how much demand there's going to be.
Yeah. No, and I think the other big thing, when you look at the shutdowns, the vast majority of, again, BC is your laggard as far as profitability. So it's pretty obvious that as you stack wood in BC and you still have rail car issues, that's the obvious area where you see curtailments materialize. Somehow you don't see them to the extent that you see out of BC in places like Alberta in the east, into the U.S. South, where I did hear, though, and I haven't seen anything in writing, that with a lot of the brownouts taking place in Texas, there were some southern yellow pine mills that were experiencing outages and shutdowns as a result. So I'm curious if anybody is out there has any definitive information on that, please forward it along.
Yeah, I think what's kind of bleeding through is you and I might be a little more bearish than bullish. I'll admit to it, but I'm cautious. I am a cautious bear. I think we're in a mature bear market, like we've gone down for a while. And there's just some weird headwinds like that. Like if it's too costly to actually run your sawmill because of power constraints, that's going to be
no. I think to me, it's always where's the most amount of hope, and I think the vast majority of people, including myself, Mike, are hoping this market higher, not lower. I don't think anybody wants to see a retest of the recent lows just yet here. I think that it's probably coming down the road into the seasonality of how lumber trades into October, November. But I think the vast majority of people, cash and futures, are still hoping that September back up into the 750 to 800 plus area, hoping cash back up into the 700, 7.25 plus area. I think you would benefit a whole, just whether you're talking futures or physical cash. I think a lot more people would be the beneficiary of that hope at higher than hope at lower right now.
And on the flip side of that coin, we've been at 300 before in recent history. There's no reason we can't go down there. So trade cautious is basically what it comes down to.
Yeah, and then I had a couple of people ask. So obviously we have July expiration on Friday. Tomorrow we have CPI. Thursday we have PPI. So you're going to get some inflationary indicators tomorrow and Thursday. That'll be market drivers. You have housing starts next Tuesday, the 19th. And then the big one for the week is going to be FOMC interest rates, 2-day meeting. They'll announce Wednesday, the 27th. So there's a lot ahead of us for the remainder of July here, from an economic data standpoint. There's a lot of things that will drive all markets, including lumber here.
Yes, there's no shortage of things to look at in the global economic arena that are affecting us today.
Yeah, no, absolutely.
This is not a simple analysis market for sure. And Greg, I really appreciate your global look at everything. Anyone has any questions for us, please reach out. We'd be more than happy to help you. And I'm very much looking forward to this new contract. I think we're going to
and again, as soon as we get definitive webinar information, we'll blast it out there. I encourage everybody, if you have any questions, you want to talk to the CME, you want the CME to answer these questions directly instead of my analysis or interpretation. Get clarity from the CME, and more importantly, they know that the industry is engaged and cares. And I think from an excitement standpoint, the Wall Street Journal, Barron's, they've all picked up on this. So lumber is still getting its 15 minutes of fame here.
Yeah, we're getting into the 20-minute range.
Right.
All right, everyone. Thanks for watching. We'll see you next Tuesday.
Thanks a lot, Mike. Thanks, everybody. Take care.
Hey, Greg, hang on.